Many people are concerned right now that the US market is dominated by just 7 stocks, the Magnificent Seven. And in this video, we'll look at the reasons behind that success, but also whether it's likely to continue and the reasons for that. But also, is it sensible to tilt away from those very successful stocks? And if you do decide to tilt away, how can you execute that decision in terms of funds that you'd buy? This video is sponsored by NordVPN, an app that lets you securely connect to the internet across all of your devices. So here they are, the Magnificent Seven. This is an allusion to a movie that was made in the 60s where a plucky group of 7 cowboys protected a village from some desperados. The analogy is a good one, I guess, because these stocks have really pushed up the S&P 500 for a long period of time. They've done a lot of the heavy lifting for the S&P's returns. So who are they? Well, let's start with the A's. Alphabet, Amazon and Apple. We have 2 M's, Meta and Microsoft. And then finally we have Nvidia and Tesla. So how is it that these companies have come to dominate the S&P 500? Is it just driven by euphoria or are there fundamentals behind it? Well, as you can see, fundamentals are a big part of it. So they make up about 28% of the market cap of the S&P 500. Here we've added one more stock, which is Netflix. This is based on data from Yardeni, which looks at the mega cap 8. But these are very profitable companies. They generate a lot of revenue, that's top line income, and also a lot of profit, that's the bottom line profit. That's also called earnings. So as a proportion of the S&P 500, they make up 19% of the profits and 11% of the turnover or revenue. Why is there this disconnect between profits and revenue? Well, it's because these companies have such high profit margins. So it's certainly true that a lot of this rally in these stocks has been fundamentally driven. There is some euphoria. They make up more of the index that would be justified if we look at profits alone. And what would happen to the returns of the S&P 500 if we were to strip out this mega cap 8 set of stocks? Well, instead of a 25% average return over the last decade or so, we'd be looking at a return of about 9% per year. So overall, they've added about 2 percentage points to the S&P 500 over this period. But the real question is whether these companies will continue to dominate as they have done in the past. And personally, I think that the answer is yes, they will. And to see why, I think it's really helpful to look at the income statement over the course of 2023 of one of the largest, which is Apple. Now, this diagram comes from a company called Sankeyart, and I think it's just a brilliant way to visualize cash flowing through a company. So on the left-hand side of this graph, what you can see are the sources of income for Apple. Sales of the iPhone made up about $200 billion over the course of 2023. That's the largest source of revenue. Then we've got MacBook, iPad, and all the other gadgets that go into the Apple ecosystem. On top of that, you've also got the services, things like the cloud storage that you get with your Apple products. And the total revenue was $383 billion. But of course, what we care about is the profitability of a company, not just its revenue. So we have to subtract things like the cost of sales. That leaves us with a gross profit of $169 billion. So for every dollar of revenue, 44 cents made it through to that gross profit. 30 cents made it through to operating profit if we subtract operating costs. So that's things like research and development. And then if we subtract tax expenses, we get the final earnings number. So that's the net profit. And that was $97 billion. And that meant that every dollar of revenue made it through to 25 cents of profit for the company, which is a very high margin. So make no mistake, Apple is a cash generating juggernaut. And this justifies its very large weight in the S&P 500 and in global indices. If you buy a global index, you'll almost certainly see Apple and Microsoft way at the top of that table of holdings. Now, the sponsor of today's video is NordVPN, and it's something which I use if I'm out and about and I'm traveling and I want to connect to my brokerage accounts. And that's because security is really important. I don't want someone else sniffing out my passwords, which they can do if you're on one of these open Wi-Fi networks. With NordVPN, it encrypts all of the traffic between you and the server so that if there is someone who's stealing that information, they won't be able to decrypt it. Also, if I'm in a foreign country and I want to access UK content as if I was still in the UK, I can do that very easily with NordVPN. All I have to do is connect to one of the UK servers, and then it's as if I was browsing the internet back at home. So let's say I wanted to access one of my brokerage accounts here on Vanguard, say, and I didn't want anyone to be able to steal my password. It's really very easy to do if you've got the Chrome plugin. Here you can see that with the NordVPN logo. I just click on that. I choose which country's server to connect to. So let's say I'll use a UK server, and it's as simple as that. I'm now protected. And if I wanted to switch that off, I just click the disconnect button. So it's really very easy to use. And NordVPN is so fast that I've never noticed it introduce a lag, even if I'm sending video traffic back and forth with a Zoom call, say. Now, as a viewer of PensionCraft, you get a special offer from NordVPN, where if you go for the 2-year package, you get 4 months free. And that comes with a 30-day money-back guarantee. So if you want access to that exclusive deal, just go to the URL nordvpn.com/pensioncraft, the name of our channel, and you'll also find that link in the description below. So if we're thinking about whether these companies will continue to dominate, I think the answer is yes, because they produce services and products that we love globally, and that's unlikely to change anytime soon. Now, of course, if we go far enough in time, if we go 10 years ahead, 20 years ahead, there'll be completely different companies. Maybe some of them will still be in the top 10, but I suspect it'll be a very different acronym and a different metaphor at that point in time. But certainly over the next 2, 3, 4, 5 years, I'd expect many of these companies will continue to dominate. Now, part of the justification for moving away from the Magnificent Seven is that they've rallied so much. And the argument goes they must now be very expensive, and what goes up must come down. There must be some kind of narrative hype, perhaps around AI, which has driven their prices higher, and that'll dissipate and they'll come crashing back to earth. But there was a recent video done by Aswath Damodaran. He's known as the Dean of Valuation, and he does some brilliant videos on YouTube, which you should definitely check out. But he has a fundamental model which he makes available to anyone, where you can enter assumptions into his discounted cash flow model, and it'll spit out a value for that stock. So he's done that for the Magnificent Seven. And what's really surprising is that the valuation of many of them is pretty close to their traded value. Only 2 of them, in fact, stood out as being overvalued, and that's Nvidia, which was overvalued by about 56%, and Microsoft, which was overvalued by about 14%. Why is it that they weren't seen as being overvalued? Well, they have been growing their revenue very rapidly, and if that's the case, then fundamentals have been keeping up with the increase in the price of those companies. Maybe not quite keeping up, certainly not for those 2 examples, Microsoft and Nvidia, but with the rest, yeah. Fundamentals have driven the price higher. It isn't just about euphoria. It is notable that Nvidia and Microsoft are the 2 stocks which are in the epicenter of the AI bubble right now. Perhaps that narrative will start to weaken, and there'll be questions about profitability and whether that tech can generate extra revenue for those companies. But certainly for the remaining Magnificent Seven stocks, their prices are fundamentally driven. And while their fundamentals continue to be good, I think their prices will continue to rise at their current brisk rate. In fact, only one of those stocks had an annualized rate of increase of revenue in Damodaran's inputs, which was less than double digit, and that was Apple. So that brings us to our key question: should I tilt away from the Magnificent Seven? Now, personally, I think the answer to that question is no. And the first problem I have with it is you have to time 2 things correctly. You have to tilt away from the Magnificent Seven at the right time, and then you have to tilt back towards them at the right time as well. What do I mean by a tilt? Well, if you have the index as a whole, you could perhaps reproduce the index, but without such a heavy weighting for those Magnificent Seven stocks. And we'll discuss how to do that later. But I'm not convinced that people can time that correctly, moving away at the right time in order to catch the peak of their outperformance and then move back in potentially when they'll start to outperform again. So this timing problem is one of the issues I have with this tilt away from the Magnificent Seven. Another problem I have with it is that I'm not convinced people can choose stocks which outperform in the first place. That also means that you probably can't choose stocks which will underperform. If it was the case that these were egregiously overpriced stocks, then maybe yes, you could justify tilting away. But as we saw from Damodaran's work, many of them aren't overpriced. So I'm not sure what the justification would be of tilting away from them other than they're very successful companies. And that's probably not a good heuristic for not buying a stock. I also think this adds complexity to your portfolio. Personally, I've just got one global fund in my SIP and in my ISA, and I like to keep it simple when I invest because that way I don't get tempted to do bad things, such as tilting towards and away from sectors, countries, which doesn't usually help my returns. But I can see that for some people, if you see such high concentration in just a few stocks, maybe you're thinking that's a big risk and you want to keep away from it. And if that's the case, now let's think about how you could actually execute that plan effectively. So how would you tilt away from the Magnificent 7 stocks? Well, I think one way not to do it is to remove the US from your allocation. And the reason for that is that the US is such a large part of the stock market globally. So if we look at the MSCI All Country World Index, which makes up about 80% of the global market cap in the stock market, you can see that the US makes up over 60% of those global markets. So taking away the US would, I think, be really like throwing away the baby with the bathwater. The US is large because it's very good at growing profits and growing share prices. So removing the US entirely, I think, would be a mistake, or even dialing down the amount of US. I think a more nuanced approach is simply to change your US allocation within your portfolio. For example, if you do break it down by region, so you could have the US, Japan, Europe, maybe emerging markets as separate funds within your portfolio, you could substitute another fund for your S&P allocation. So if we do look at the S&P 500 in the US, that makes up about 80% of the US market by market cap, and we look at the allocation to the top 15 stocks, you can see the Magnificent 7 is heavily represented there. Microsoft and Apple vie for the top space. 7% is currently Microsoft, 6% is Apple. Nvidia and Amazon make up about 4%. Meta makes up 3%, Alphabet makes up 2%, and so on down the list. However, if we move to an equal weighted index, instead of 7% Microsoft, we'll end up with 0.2% Microsoft. So we take 100% and we divide it by 500, that's 0.2% per stock. So what that would represent is a massive underweight in Microsoft and Apple, say, and a huge overweight in all those tiny little stocks in the long tail of the S&P 500. So let's look at the historic performance of a tracker of the equal weighted S&P 500 index. The ticker of this ETF is RSP. It's managed by Invesco, and it's the S&P 500 equal weighted ETF. In fact, it's outperformed the S&P 500 in the form of the S&P tracker SPY since 2004. Not by a lot, it has to be said, by 0.3% per year, but still outperformance. However, a lot of that outperformance came in the past, in particular during periods when markets were crashing. So if we look at the annual outperformance, what you can see here, when there's a blue bar above the axis, that's when the S&P equal weighted index beat the normal S&P. It happened in 2009, that's the big blue bar you can see, and it happened in 2022 during the tech wreck, when a lot of these mega cap tech stocks suffered huge falls in their prices. However, if we look back over the previous decade, it's unusual to see a year in which the equal weighted index is outperforming the S&P. So certainly if you were tilting that way for the last decade, you'd have been hurting for many of those years. And that's because these stocks have simply been so successful. Now, one thing to watch out for is the fee that you pay for these equal weighted trackers tends to be higher than it would be for the S&P 500 because market cap is just a more efficient way of weighting an index. You buy more of the stuff which is most liquid, whereas for the equal weighted index, you're having to churn that very long tail of relatively illiquid stocks, and that's more expensive to trade, and that'll be passed on to you in the expense ratio of the fund. Another way that you might approach this is to split out the S&P 500 into its components. Now, the S&P 500 is the 500 largest stocks in the US. There's also a mid-cap index in the US, which is called the S&P 400, and there's a small-cap index, which is the S&P 600. So what you could do is buy some combination of those. For example, you could still have the S&P 500, but then you could have a slug of small caps simply to tilt you away from the mega caps. And then if it is the case that the S&P 500 is not going to perform well because there's a drawdown in those mega caps, then the S&P 600 in theory should protect you. Or maybe the mid caps is something you prefer. Small caps tend to be more volatile, and if there's a period of weak economic growth, they tend to suffer more. So if you do want to tread the middle path, mid caps may be the way to go. And there are trackers for these in the United States and also available in the UK. Just ETF is going to be your friend here to find them. So personally, I'm not going to tilt away from the Magnificent Seven. I think these are very successful companies whose products and services touch all of our lives daily, and that itself tells you that you probably want to keep exposure to them while that remains the case. But I hope in this video you've seen, if you want to tilt away from them, how you could potentially do that, how you'd execute that strategy. Now don't forget our offer from NordVPN, which you'll find in the description below, but the URL is nordvpn.com/PensionCraft, and if you use that link, you'll get 4 months free with your 2-year package. And, as always, thank you for listening.